Hi everyone, my name is Piterpakulski. Today we will continue building financial model for a bakery. So we are talking about a small business ideas in this series of videos. And today we will be answering the second very important question: what is the payback period of my business idea? So during previous video we've calculated the amount of financing that we need to start our story, and now we need to calculate when we get this money back. As usually, like, share, subscribe our channel. You can always order financial models from scratch for your unique business ideas. We can help you with that. At the end screen of this video I will give you the link to the playlist where I will be keeping all these tutorials. And when I completely finish this model, I will give you all the links in the description of this video as well, so you may watch all the tutorials from scratch till the final overview. So hope you enjoy the process. First of all, let's briefly run through what we did during previous tutorials. So let's go to the top. So we have the unique rule through the whole our financial model. So blue cells are our inputs. We are not putting the inputs inside other types of cells. So these are the inputs, these are the inputs, these are the inputs. All other cells are formulas, as you can see. So we are not putting the data inside these cells. We are working only with blue cells. So first of all, we're starting with creating a list of products, different types of breads, cakes and so on that we are selling. We can switch them on and off from calculations to see what will be the cash flow statement, payback period with or without different types of breads. Then we are setting up the monthly sales plan. We have global and local coefficients for the sales plan. We can increase globally the whole sales plan or decrease it, or we can, for example, dive into specific items and increase the amount of sale for this specific item. Then we are moving to prices, selling prices. We have global and local coefficients for selling prices for future scenario analysis. So these global and local coefficients, they become very valuable at the final steps of your financial modeling, when your model is ready and you need to look what will happen if the revenues increase, if the revenues decrease, if the costs will rise. And you can easily play with these coefficients without playing with inputs themselves. You can use just percentage values and see what will happen with your project. So this will give you a lot of new information about your business idea. Assume that we have 5 types of customers,
so we can name them. Then we allocate the revenues between these types of customers. We set up the average check for each type of customer. We can switch on and off different types of customers from calculations to see what will be the cash flow, what will be the simple discounted payback period, net present value if we are too optimistic with this or that type of customer. Then we have the list of ingredients which play part in producing these cakes, these breads. So these are the products. These are ingredients. This is the price per 1 unit of ingredient. We can switch on and off different ingredients from calculations. We can increase and decrease the price of ingredient globally and locally. Here on the next tab we have our
products from top to the bottom. We have ingredients from left to right, and here we specify the consumption of ingredients to cook one bread type 1 bread type 2. So for example, to cook one bread type 1, we need 5 units of ingredient number 1, and we need 8 units of ingredient number 15, and this will give us the direct cost per one bread type 1 of $15. So this is how it works. So these are the recipes, and then these recipes flow into the model. So what is next? So here we have the huge list of ingredients. We are setting up when we get the first revenues, year and month. This is
when the operating activities start of our bakery. Then we assume that different types of customers, we will be reaching the target revenues for different types of customers with different speed. So this is very important because playing with these percentage values, so for example, some types of customers we will be reaching the target revenues with a lower speed, some of them we will be reaching the target revenues with a higher speed, and this may produce some operating losses that we will have to additionally finance, and these operating losses will be added to our investment plan expenses and finally form the final amount of financing needed to start the business. And so this block of inputs is very important because playing with these percentages, so for example, so these percentages, let me show you. So these percentages will affect the revenues and direct expenses and may produce these losses, which will affect the amount of financing that we will need, because we will need the financing during the investment stage, and we will need some additional financing during operating activity here, because we have losses that we need to finance as well. So that's why when we start playing with these values, we will be able to see in good scenario and bad scenario the difference between financing needed. So this will be a very interesting stage for you when you start playing with your model. Then we are moving to fixed costs. So here we have the list of fixed costs. Then we have the typical year. So fixed costs, despite of them being called fixed, they may have some seasonality, and here we have the typical year from January to December, where we will be allocating these costs. We have global and local coefficients for these costs. We can switch them on and off from calculations. Then we are moving to the payroll. We have the list of positions, the salary per person on one position, the amount of people on each position. Then we are setting up the global and local coefficients and the block where we are able to switch on and off different positions from calculations. Then we are moving to investment plan. Here we specify what we are investing in. This is the moment when we start operating activity, and before this start 3 months period, we can specify what we are investing in, how much we are investing in, and when we are investing in. So we have global and local coefficients and switch on and off buttons for each investment plan item. Then we are moving to the loan modeling. So then we specify the amount of loan, term of loan, interest rate,
when we get this loan, if we have any grace period for principal payments, interest payments. Then we specify the tax rates. Then we are moving to the cash flow. So this is our cash flow. Then we calculate, using the cash flow, we are calculating the financing needed. And now now we are moving to the simple payback period diagram and calculating the simple payback period itself. So I will copy this table. So what I will do, so to calculate the simple payback period, we need to gather the inflows and outflows of the project itself, to make us understand whether the project itself generates enough cash to pay back all the money that we've invested in it. So what we are doing, we're taking the result from operating activity plus the result from investment activity, then minus interest payments and minus principal payments. So we're not adding the inflows of equity and loan to make us see whether the project itself can generate its own cash without any compensation from our pocket or the loan. So then I'm pressing enter. Then I'm making this formula cumulative. So here we have a very interesting line. So this line consists of two parts. The first part of the line contains negative values, and the second part contains positive values. So this, the moment when a negative turned to positive, so in September 2026, this means that the amount of money that the cash generated by the business equals to amount of money that we put inside this project. So this is the moment of payback. Here it is. And if we want to calculate the amount of months, we can just, what we can do, we can write a very simple formula. So if this value is less than 0, we will put 1, otherwise 0. Then we will extrapolate this formula to the right. Now we can create a total for this line. And now we know that the simple payback period of this project is equals to 41 months. So the simple payback period is 41 months, and the moment of payback happens in September 2026, when red turns to black, when negative turns to positive. And what we can do now, we can create a diagram for this line to make to create a picture of the payback period. So let me do the following. So now let's select this line. Let's insert, then select the diagram type. Let's select the data, the timeline. This is for OX axis. So if we look attentively at this diagram, so the moment of payback occurs when this diagram crosses the timeline axis. So this is the OX time axis, and the moment when this diagram crosses this axis means that at this time the amount of cash generated by the business equals to the amount of financing that we put inside this project. So this is this moment. So this is September 2026, and if we go to September 2026, so here it is, when the moment when negative cumulative cash turns to positive. And now we can, for example, create different scenarios to see what will happen to the simple payback period. So we can, what we can do, we can create a new tab, say PP payback period. We can, what we can do, we can copy this diagram, put this diagram here, now what we can do, we can, for example, start playing with some inputs. So for example, if the for example, let's copy, we were building some scenarios before. So for example, when we want to test some scenario, for example, what would happen to the project if the sales plan will decrease on 20%. We will take only 80% of the current sales plan. We can use this global coefficient, go to payback period diagram. We can see how the payback period displaced. Or for example, let's say it will be 70% of the sales plan. We can see how the diagram moves. Or for example, what will happen if the sales plan will decrease but the prices will increase on 20%, for example. And now we can quickly create a huge amount of scenarios. We can play with inputs the way we want. So now let's put the base scenario. So as you can see, the moment when the payback moment occurs is the moment when this diagram crosses the timeline axis. And well, I hope this video was useful for you. Give us a like, subscribe, share this video with your friends. You can also order financial models from scratch for your unique business ideas. We can help you with that. At the end screen of this video, I will give you the link to the playlist where I will be keeping all these tutorials. And when I finish this model completely, I will give all the links in the description of this video as well, so you may watch all the process of creation of this model from scratch till the final overview absolutely free. So thank you guys for watching. See you in next videos. Thank you and bye.